The purpose of this panel, which is a little different than what we did last week with the three real estate equity, is Patrick Carden runs a real estate debt fund. But more importantly, the way in which he runs the fund and the governance and the controls is really what I wanted Patrick to speak with, and he's joined by John Rosenfeld. So let me just introduce Patrick first. He's founded Window Rock Capital Partners, a management company focused on investments in distressed and opportunistic consumer credit backed by residential real estate. At Window Rock, Mr. Carden oversees 350 in distressed loans and residential assets. Baseline is the culmination of prior work experience combined with a progressive and problem-solving approach to find unique niches and inefficiencies in the real estate and private credit markets. Mr. Carden holds a BA in history from Columbia University, where he is a Merit Scholar. Next, we have John Rosenfeld. John is a business and transaction attorney with 27 years experience representing early stage and small companies and their investors, both as outside and inside counsel. Mr. Rosenfeld brings a unique background of legal, finance, investor relations, and transition management expertise. He received his Bachelor's of Science in Business Management Finance degree from the University of Southern California in 1988, his Juris Doctorate from the University of Southern California God School of Law in 1992, and John has served on a variety of community boards and associations, including California State Senator Calderon's Construction Defect Task Force, Mayor's Zoning Task Force Santa Barbara. Let's welcome John and Patrick. Guys, welcome to the summit. It's great to have you here. Patrick, let's start off with you and talk a little bit about you as running a family office. You're a longtime real estate investor, and over the years, what has worked well and hasn't worked well as our audience looks at the potential of investing in real estate, and then kind of move into what you're doing now and why you built in the various protections that you did.
Sure. Well, first, Walter, thank you. Thanks for having me here today. This is a topic that is important to our family and hopefully also important to other investors. As a family office, we've invested with a number of different managers, and over a number of years, we've learned a lot of lessons. And one of the important lessons we've learned is governance and transparency in funds. As we've invested with multifamily or multifamily real estate, private equity, venture capital, transparency, especially after the last financial crisis, with everything that occurred, transparency and governance became extremely important to us. So our family invests in a number of different, we manage assets, invest in a number of different strategies ourselves, both from commercial real estate and debt backed by commercial real estate assets. So essentially what we've done is I kind of sit on both sides of the table. One, as a family office, we see a lot of opportunities. We have a lot of managers come to us. So I get an opportunity to see what the offerings are and evaluate the pros and cons, the transparency, the governance. And also as a manager, I get the opportunity to report to investors and stakeholders and let them know how things are going with their investments with us. And so to speak to what we're doing recently, most recently we've launched a credit fund focused on first lien lending to experienced operators, commercial real estate operators. We do loan to values conservative, it's 50 to 70%, and short duration, typically 12 months. The product we're very excited about the product, especially given the environment, but what we've really done is work to create a product that frankly would be something that we would invest in as a non-affiliated sponsor. And what I mean by that is we've really worked hard to put the pieces in place that would be important to us. So first, one of the first things we look at in any fund is how are the assets valued, and who's doing the valuation. So in our particular fund, we have a monthly net asset value calculation, and it's done by a third party. That's very important to us because we want, as an investor and also as a manager, we want third-party eyes on what we're doing. In addition to that, we have an audit by a third party. They come in on an annual basis, provide services for us. And we also have a fund administrator that provides accounting and reporting to investors. So these are some of the three basic things that we've provided for investors for transparency. There's also another level at an asset level that I can speak to as well, but I'll kind of pause there.
Great. And John, you kind of come in as the guy that reads the documents. And so speak to, most everybody loves each other when they're embarking on a new investment. And so speak to things that can go wrong. And the way that people should look at things with the eye towards a little skepticism.
Well, thank you, Walter. Yeah, that's a very important point. Oftentimes you'll hear from a client or their advisor, it's a terrific deal, we've already done all the due diligence, we understand this deal and we really like it. Can you take a quick look at this? Whether you're the financial advisor, the accountant, the legal advisor. What's most troubling is if that documentation has nothing to do with what you were told the actual deal is. So it's very important that you actually share that information with your advisor, whether your advisor be your financial advisor or a legal advisor, fairly early so that you're not emotionally invested in the deal before somebody evaluates whether actually it stacks up the way you thought it did. One of the things that's very important, just like any relationship, is setting up those bridges and connections in the management structure itself so that you can avoid problems early on and address those as they come up. And so what you're looking for in the documentation is accountability, responsiveness, and very importantly, regular reporting. Reporting is just so important, and with private equity, a lot of that is kind of pushed to the side. Give me a call if you have a question, let me know and I'll respond to it, says the manager. Well, that's not very good in terms of you being able to evaluate and understand and see something that could be problematic coming up. Or your accountant might be able to find something that is just a question and you want a response to it. But if those little questions develop over time, they can become a big problem later on. So you want to make sure the documentation has protections for the investors. You have ways to remove the manager if there's gross negligence or something like that. But most importantly, a relationship that you understand, the documentation reflects the actual deal, and there are ways to have information early and regularly.
You mentioned something that I want to highlight, and you mentioned the ability to remove the manager. Now, I don't know that anybody, when they think about going into a deal, will look at the structure of a document and look at the removal provisions. I know, John, you and I have been in the trenches on a number of things, and we were shocked at the language in a document that was a very, very difficult, the language was such, it was very difficult to remove the manager. You would think that it would be a simple majority, 51% of the investor capital could then take action. So that's a great point. It's just that I think it's important for people to understand that we love each other at the beginning of the deal. The glossy's great, everybody's going to make a lot of money, but what we know is that significant amount of opportunities go bad. And so, Patrick, why don't you talk about, so there's many companies that do lending. And so speak to why you decided to create all these various controls inside your fund versus, hey, I'm a good guy, I'm honest. I'll just do my job. Be cheaper.
Yeah, so there are a lot of groups that do lending, and they go by a number of different names. When we looked at the market and looked at lenders, what we had a hard time. There was a mismatch in a number of factors with governance, transparency, and what we didn't see was right off the bat. I mean, one of the things John said is we didn't see a sophisticated structure. Lack of controls, lack of governance, lack of transparency. Oftentimes, a lot of lending platforms out there have very loose documentation, and if everything works out okay, then you're probably going to be okay. And if something goes sideways or you go into a difficult environment like we are in right now, you're looking at documents that can be unclear and provide a very difficult workout situation. So just generally speaking, there's a lack of documentation, lack of governance, lack of kind of controls. There's also, a lot of the lending out there is done, it's kind of a relationship type business. People know the lenders, and they build relationships with those lenders. And oftentimes, they're friends until something goes wrong. And then so there's just not a professionalization of the lending platforms that we saw out there. What we really tried to do is say, let's take what we're seeing in credit funds, in private equity funds, kind of the best of best practices, and let's put those together in a lending platform. We were already lending out of our family office, and given the environment, we felt like volumes would increase. So this would be an opportunity to not only invest more of our own family capital, but also provide for other investors. And so we put a structure together that really professionalized the private lending and put it in a structure that's that provides, in our opinion, very transparent and very attractive investor features.
And in this category, not your particular fund, we're just talking about generalities, but what in real estate debt, what can investors expect to achieve in terms of returns? What's a typical range?
That's a great question.
It's probably all over the place, but
yeah, it depends on what the way I approach this is I like to ask the risk question first. What type of risk are you willing to take to generate a return? And what I'm always amazed at is what people are willing to do for an extra 2 or 3 percentage points. The type of risk they're willing to do. In private private debt, returns are typical. I'd say on the low end, it's 6 or 7%. On the high end, you're going to see mid-teens. What I think is really important is to dig in and really look at what the risk is associated with those types of returns.
Great. Now, John, from a document standpoint, what do you see for our audience? What are the 2 or 3 things that somebody would really want to pay attention to? Now, I'm going to kind of hint at, the fees as being one of them, because they're oftentimes buried, or they're very difficult to sort of figure out. So, but from your vantage point as a transaction attorney over the years, what are the things, one, you want, and then 2, what do people overlook?
One of the things that Patrick just brought up, which I think is very important, is understanding what the actual risks are. And some people will be entertained by a particular type of venture. They'll be enwrapped by the concept. And of course, the manager, who's got it all figured out, understands how to address each one of those issues and tells a story that is kind of the plan A. And it doesn't talk about plan B or plan C. So it's important to understand how, what level of risk you're comfortable with, and then have that discussion with counsel, and then say, okay, well, what happens in the situation where the manager, things go rough, and the manager's true colors come out, the manager becomes unavailable, doesn't respond? What can we do in those situations? What rights do we have to remove the manager? A very strong provision in favor of the manager often requires that the manager actually be shown to be grossly negligent in a court of law before they can be removed. You want to look at provisions like that and say, no, we need to be able to allege in good faith that there is this breach of the agreement and there's gross negligence that's going on in order to then vote to remove you. Provisions like that are very important in terms of limited partner control. Also, the personal guarantees or any types of shared risk provisions, looking at where the risk lies, what happens in the event of a default in your business that you're investing in. How does that play out? Does the manager have the capability and the responsibility to step forward and remedy some of those defaults as well? those are some of the things that you want to look at in terms of how does the business fare if things are not going well, and what rights do you have to step forward to be able to take some control, to be able to exert influence, get accurate reporting, and if need be, remove the manager and take control.
How about capital calls, John? Can you speak to, a lot of times people go into an investment, they have no idea that they could be on the hook for additional money.
Right, that's very important. Typically, a limited liability company or even a partnership to a large degree would not require capital calls. However, a mechanism is oftentimes included in the organizational documents as well, where a manager can show a need for additional capital to satisfy a requirement of the operations, and then have a capital call to all the investors where they have to respond on a pro rata basis. Now, there are various provisions in how an investor would have to respond, and if they're unable to respond, what happens then? The typical situation is that they would be diluted out by any investors who would step forward and take care of their pro rata share of that capital call. There are other provisions, and we like to include these, especially with a smaller group, where if no one else steps forward, if somebody steps forward, that would be a member loan to that particular member. But if there's a large enough deficiency in the capital call responses, well, then the manager has to go out and obtain a third-party loan. So that's a way of handling that as well. But you want to understand what happens in the event that you're unable to respond to a capital call. And oftentimes we look at a several tiered level, or tiered response to that, so that you're not automatically diluted, it's not automatically a breach of the agreement as well, so you're not in default. But there are some provisions built in so that you have some options in that situation.
Thanks, Patrick. Parting comment, what would be the 3 or 4 things that you as either an investor would want to have in terms of governance before you would invest? Or what should people ask for?
So one of the things I would ask for is who's pulling the trigger? Who's pulling the trigger? Who's making the decisions? How are the decisions made? And how are they compensated? That's in a lot of these, you are buying investments, but you're also buying heads, and it requires in active management and alternatives, it requires people to execute. And so I would really focus on who the manager is, what's the process, and also what happens if that manager, what is the process for that team, if it's one person or a committee or how that works. So the team would be one thing that would be very important to me. The second thing is I would really look at incentives. How is the team incentivated? What happens in good situations and what happens in bad situations? You don't want to be in one of these situations where heads the manager and the investor wins and tails, the manager wins and the investor loses. And so oftentimes when investments go wrong, incentives change, and you want to make sure that manager is incented. That's looking at skin in the game. How much does that manager have invested? How are they making decisions? What motivates them? And then the third thing I would look at is transparency and responsiveness. How are they reporting? What are they reporting? What does the reporting look like? Is the reporting, do they have other people? Walter has this great saying of getting into people's kitchens. You want to be able to have access to that manager, access to the information, and make sure that other parties are looking. There's oversight from people outside the organization, which is very helpful.
Great. Well, I just want to thank the two of you for coming to us at the summit and sharing your experience. We will be right back in 2 minutes with the continuation of the program.